Welcome back. We're going to talk about asset allocation categories today. And what I mean by that is this. We've been talking about 401k and an investment through a employer sponsored investment plan like a 401k. And so for example, 10% of your income might be dedicated to your 401k account. That's going to be taken out of your paycheck. Your employer might match that and then take that money and send it off to some sort of an investment company, a Vanguard, a something like that, a Baker Boyer here locally, the trustees. And someone is going to be tasked with the job of taking all your money and then investing it. Well, how do they know where to put it? What categories are they going to put it in? Well, your employer will give you anywhere from 6 to 10 different options, or I like to use the term flavors just for some simplicity, of various risk categories you can put that in. And that kind of varies. Again, I'm making broad brushstrokes today, but you're going to take 10% of your money and then you're going to allocate 100% of that money into different investment categories. So again, you're taking a slice out of your income and then you're putting it into this big pie of deciding where do I want my money to go. This person, for example, has 75, 10%, 15% in three different unnamed categories. We also use the term asset allocation categories, or different places we can actually park our money. All right. So some terms you need to know here for starters, supporting terms. One is market capitalization. Market capitalization is how much is a company's stock worth at any point in time. Okay, so that'd be take all the possible shares that can be traded and multiply it by their last trade price, and it essentially gives you a thumbnail or an estimated valuation of how much a company is worth at one point in time. So for example, I have Cisco Systems here. Cisco again produces a lot of the stuff you have inside your computer. And right now, if we look at Cisco, their last trade price, so right now they're running at 42.26 per share right now. But if we took all the possible shares of Cisco that can be traded and multiply it by their stock price, we come up with, over down here, market cap 179B, or $179 billion. Okay? So that's market capitalization. We use that to determine the sizes of companies relative to their different risk categories. Next, we talk about debt. And corporations raise money. Say they want to go into a new market or a new country or develop new products or whatever. They don't have the current operating cash to make that happen. So they go into debt. Now, debt can be one of two things. Number one is they can go out and get a bank loan. Say we want to get a such and such $1 million loan or $1 billion loan. I was part of a roadshow in about 20 years ago. My boss said, "Hey, you want to go to Denver tomorrow?" I'm like, "Sure." Jumped on the company plane the next day and off to Denver we went with a bunch of our executives. And I got to be part of about a 2-day negotiating process with PNC Bank in Denver, and we were trying to ask them for a $20 million loan to expand our business. It was very educational for me, an experience I will never forget. But we were trying to raise money for our company through debt, in this case, getting a loan. Another way corporations raise money through debt is they go to different individuals and they put bonds out for sale, and they say, "Hey, you individuals, if you want to loan us 5,000, 10,000, whatever, we're going to sell several $1 million of bonds." And with a bond, you're actually loaning money to a corporation. You're not buying stock. You're just loaning money to them, and over a period of time, they will pay you back interest, that extra amount that they pay for using somebody else's money. They will pay you interest over time, and they will pay back their debt to those individual people who bought those bonds. If you want to look at College Place High School and the financing of our high school, the school district didn't have the cash laying around to build a new high school. They had to go out and sell bonds, or people could then buy these bonds and loan money to the school district so they would have the cash to build the school. And over a certain number of period of years, 10, 15, 20 years, whatever, the school district pays those bonds back, that debt back. Okay? So corporations, you need to understand debt. They raise money either by going and getting a bank loan, or if they don't have if they don't have the money available to them, or they go out and they sell bonds. Next, we talk about equity. Equity means an ownership share of a corporation. So another way that corporations raise money is they can say, just like Shark Tank, where they say, sharks, if you'll invest $300,000, we'll give you 20% of our company or whatever. Corporations can grow and raise money by giving away part ownership in their company, and usually that is in the form of stocks. They're letting people invest in them and become part owners of the corporation. The reason is so they can grow their company and have some cash to do that. A mutual fund. You will have seen a video that I shared with you on 2 cents. If you haven't seen that, go back and review those 2 cents videos. Mutual fund is where money is pooled, where a whole bunch of different investors, maybe hundreds of different investors, are taking their money, and rather than each one of them trying to invest in individual stocks, their money is being pooled together to then actually somebody then in turn is taking that money and going and buying stocks with it and investing with it. So for example, I don't own a stock directly at all. Nothing. All my money is in mutual funds. So while I don't own stocks directly, I own a little part of a share of a particular mutual fund, which in turn owns individual stocks. So it's like I'm a third party owner, if you like, of stocks through that mutual fund. So with mutual funds, again, money is just being thrown into a big pot. Someone is making a decision about where that money is going, and then a trustee goes and actually goes out and buys that stock, which is owned by the mutual fund. Again, watch that video if that doesn't make sense. We've used the term diversification a lot, and diversification is just simply spreading your risk rather than putting all your money on one pot, putting all your money on one company. You're spreading your risk out 5, 6, 7, 10, whatever, how many stocks you have to diversify your investment. And if you have your money in mutual funds, you're automatically diversified because that money is going to be invested in a whole bunch of industries, market segments, company sizes, all that kind of thing to spread out your risk. Liquidity. Liquidity is a term we use when how fast can we turn something to cash. All right? Well, some of you have green stuff in your wallet right now. That's as liquid as it gets. That's already green cash. That's liquid. But how fast can it take to turn something into cash? Well, I'm looking right now at my computer, my laptop. I could probably go out and put this on Craigslist or eBay or something, and maybe in the next couple of days, I would actually have cash in my hands to turn this laptop into green stuff. It might take a couple of days. But if I own like a plant of, say, 150 acres, some huge processing facility with parking and buildings and all that, and I want to turn that into cash, so maybe I want to get rid of a part of my business or sell some land and invest it somewhere else, that's going to take not just weeks, but several months to find a buyer, negotiate a deal, go through the whole transition process. That's going to take a long time. So that's not very liquid at all. So we go from very liquid to not liquid at all. And again, liquidity can determine risk involved with a company, like how fast can they turn something into cash to either assist in their operations, pay off debt, whatever the case might be. Because it's all about this right here, capital. Now we use the term capital here just to talk about the cash you need to run a business. So when you talk about businesses, entrepreneurs, something like that, and capital, we're saying we need money to run this business. Because a lot of businesses fail because they do not have adequate capital on hand to continue their business. Look at the XFL, the XFL Football League. They just folded a couple weeks ago because they ran out of capital. Vince McMahon could not finance them over a period of time, and this coronavirus just killed that league, shut their season down in their first season, and they ran out of capital, and it was all over. All right? So capital is the cash you need to run your business. More definitions here. All right? Whoops, I kind of skipped ahead there. Small cap. Now I'm going to give you some general numbers. You don't have to write these down. You're not going to be tested on how big these are, but just kind of general broad brush strokes. Small cap, again, we're talking about market capitalization, the total value of a company's stock at any point in time. Small cap is generally a company from 300 million to $2 billion in market capitalization, or how much is their stock worth at any point in time. And you may say, oh my goodness, $2 billion, that's so much money. When we're talking about the size of a company, that isn't really relatively that big. So small cap companies would be emerging companies. Maybe they were mom and pops for a while, and sole proprietors, and just somebody that was operating out of their basement or whatever, and they started to grow, and now people are starting to invest in them. At one point, way back when, Microsoft was a small cap company in the mid 70s with Bill Gates and Paul Allen, and a bunch of guys sitting around in probably a small office developing the software that no one had even heard of the word software at that point. They were once a small cap. So they're an emerging company. Probably haven't heard of them. They may go belly up in 3 to 5 years and go out of business, or they could take off and be successful. Small cap. Then we move on to mid cap. Mid cap, as far as its market capitalization is concerned, probably runs somewhere between $2 and $10 billion of market capitalization, or of companies. We talked about the total value of their stock. They're in the mid range. They've maybe been around a little while, still kind of getting their footing. They're not like with the big boys yet. You might have heard of some of these mid cap companies if you were to be given a list of them, but a lot of them are still pretty obscure. That's the mid cap area. Then we get into large cap. This is greater than $10 billion of stock. If you look at your Dow 30 companies, which we have in the past, those 30 companies which make up the Dow Jones Industrial Average, those would all be definitely large cap companies. They all have more than $10 billion in market capitalization. So they're the big boys. So small cap, mid cap, large cap. When we think about domestic companies or United States companies that we can invest in, they would probably fall in one of these three categories. Okay, again, I'm making broad brushstrokes. International fund. Now our money is leaving the United States. It's going into market segments, to industries, to areas that are going overseas. It's beyond the control of the United States government. We might have corruption, we might have drought, we might have war, we might have financial upheaval, we might have the euro going crazy, or a company going broke like country going broke like Greece, or whatever. We're taking a big risk here with international fund. Okay, it's out of the U.S.'s control, but it's another option of investing money overseas in some sort of business venture there. Finally, we have fixed growth, which is easily the lowest risk, but also the lowest return category, where we're putting our money in short-term investments like money markets, certificates of deposits, United States Treasury bills, where money is being invested in the United States government, which has a very low return but a very low risk. And fixed growth is a place where if you think the market's going to be volatile for a time and just start going crazy. Again, when I say volatile, we're talking about the ups and downs of investing and how crazy your stock is moving. If you don't like that stress, you just park your money in a fixed growth fund, and it'll kind of grow really kind of slightly, just a little bit, maybe 1 to 3% over time. But it'll grow, but not very fast at all, but it'll be less risky. That's fixed growth. So that's 5 different categories where you can invest your money with a definitely different risk category in each one. Now, if I was to range these, I would say the lowest risk is fixed growth. Okay, now I want you to just pause this video for a second, stop. Based on what I just said about these different areas, stop and arrange these 5 by risk and what you think. I just gave you the first one, fixed growth. Pause. 3, 2, 1, pause. Okay, we're back. Fixed growth is the lowest risk. The next lowest risk would be large cap. All right. Then mid cap, middle-sized companies, $2 to $10 billion. Small cap, emerging companies, probably haven't heard of any of them. And then finally, the most risky would be international fund. So fixed growth, large cap, mid cap, small cap, international. We're looking at levels of risk from smallest risk to largest risk. Of course, the larger the risk, the greater the return, also the greater possibility of losing money. Okay. When we talk about risk analysis, and I'm going to go over these just kind of briefly, companies are riskier based on some of these factors. First of all, do they have access to capital? Capital, again, being that cash you need to run a business. Do they have quick access to money, or is it going to take them a long time to raise funds if they need to change directions, if they have some financial difficulties? This whole COVID-19 thing that we're currently going through, this is testing the ability for companies to stay afloat. They got people laid off, they're not selling anything, plants are closed, people are all at home, stay safe. And so do they have access to capital to get them through the tough times? And we're going to see a lot of these smaller companies here right now in the next few months, unfortunately, start to fold because they weren't ready for this. So access to capital. Track record. Do they have a proven history of being successful? These large cap companies, some of them go back decades, if not 100 years. GE, for example, or General Motors, or whatever, been around forever. You can go back and look at their financials from probably the 1930s to the 1990s to current. Okay? Track record. They've been around a long time. Small cap companies, generally they've been around for less than 5 years. You've never heard of them before. They don't have much of a track record at all. Some of them may be just a few months old, and they're just guessing where they're going, and they're a big risk. Available information. If you go on the internet, you can look up financial information, financial reports, income statements, balance sheets, cash flow statements on a variety of publicly traded companies. Because they're publicly traded, this information is available to the public. And these large corporations have just gobs of information out there you can look at to make an investment decision. Compare that to a small cap company, and so much. It's going to be harder. You have to really dig for it, do your research. There still can be very successful, but you have to dig for the information. So that makes the large cap companies less riskier because their information is readily available. Let me make sure I didn't skip over anything there. Okay. I'm not going to click on this link, but a prospectus. A prospectus is where you are trying to convince someone to invest in you. And so you can look this up further, and I've got a little follow-up to the movie as well when we talk about prospectus. We're talking about like either an electronic or paper flyer, probably electronic now, a flyer that a company releases, has its financial results, has some of its historical results and performance as far as how much profit they've been making, where their sales and expenses and things like that over time. Understand that all the information in that prospectus must be reviewed by an independent third party called an auditor, and they are being guided by the Securities and Exchange Commission, the SEC, which I'm going to touch on another time as well. And they must have that information all reviewed. They can't just throw whatever they want to out there to the investors, because the investors are depending on the accuracy and the fairness of that information to make a decision. So that is a prospectus. Again, if you want to Google that, Google it, or go to investopedia.com, upper right-hand corner. Click on the little search button. I've got a little video later on to show you about that. But go up and search and look at prospectus if that's something you're curious about. Okay. Fun facts about different risks. First of all, small cap companies in times of growth, times of economic growth, small cap companies grow way faster than large cap companies. If they're an emerging company and it's a time of growth and people are buying stuff and things are taking off with your economy, the small cap companies are probably the best investment, even though they're more risky. They're best investment in times of growth and prosperity. Of course, in times of like COVID-19, they might be the first ones to suffer. When we talk about international funds, it's a fact that somewhere in the world is a company that's not a company, a country. Somewhere in the world is a country that's doing better financially, economically than the United States. And they could be a much better investment than a domestic investment security in a corporation, in a U.S. corporation. So if you can find those, again, they're very risky, international funds are, but if you can find those areas of those pockets in the world which are growing and hopefully aren't as volatile as others, you might have a really good investment there with an international fund. Okay? And there's some fun facts for you, and I hope you enjoyed that. And here we go.